Hey, it's Mike, and I wanted to do a video on why you should sell options. I did a video on why you should sell covered calls, but I thought it might be necessary to talk about why you should sell options in general. So I love to sell options, and this was after I started out, like a lot of young investors way back when I started buying calls and buying puts, and my money evaporated very, very quickly. So now I sell options and I consistently make a profit. So let me explain. What I want to do is, hopefully, if you're a new investor, maybe you've been watching Wall Street Bets and hearing about people making $30,000, $40,000 on by buying calls and puts. And it's kind of like doing your financial planning by looking at someone who won money in the lottery. It's just, over the long term, buying calls and puts is going to be a money loser. So let me explain why. First of all, 80% of all options expire worthless. Options are kind of like insurance policies. So when people are worried that the market's going to drop, they buy puts. If people think that the market's going to go up, they buy calls. But in most cases, the market kind of slowly moves upward. And because of that, a lot of options expire worthless. And when you sell options, you're kind of like an insurance company. And as you notice, like with an insurance company, like your car insurance, you pay your car insurance every month, but maybe only once a year or once every 2 years you actually file a claim. And in the long run, the insurance company makes more money. So you become like the insurance company. And as you probably have noticed, insurance companies do not go bankrupt very often. So it's better to be a seller of options than a buyer. And that's because people overestimate moves in the market, especially after big moves. So for instance, after the big crash in 2020, March of 2020, put options became really, really expensive. However, as you saw, the market reversed and moved upward after that. So all those expensive put options expired worthless. So if you were selling put options during the crash, like at the crash, you made some pretty good money. Now, after big moves in the market, the prices of options are inflated. That's when you sell them. So that's what I just mentioned before, is that you want to be a seller of options, especially after big moves in the market, because people will think those big moves will continue, but usually they reverse or those big moves do not continue. It's kind of like selling hurricane insurance after a hurricane hit. The chances of another hurricane hitting that specific city is going to be very remote, but people tend to want to buy hurricane insurance after the hurricane hits. So that's the thing. So let me show you the best option strategies for generating income. And I'm going to talk about two strategies that I have used. And I'm going to mention some option selling strategies that I do no longer use because they're not as profitable. But I like doing cash secured puts and covered calls. In particular, cash secured puts. So if you don't know what a cash secured put is, basically you sell a put, but you put as collateral 100 shares of the stock at the strike price. So let's say you have GameStop. GameStop's at $13 a share, and I decide to sell a $12 cash secured put. I have to put up $1,200. So that's the strike price, 12 times 100 shares. That's $1,200. Covered calls is you sell a call, but you own 100 shares of the stock. So let's say you sell a call of GameStop at 14, but you own 100 shares of GameStop, and GameStop's currently at $13 a share. So basically, it's kind of the same thing. You're selling calls and puts, but you're putting up 100 shares, either 100 shares of collateral or the cash equivalent of 100 shares of collateral. And as I said before, I use cash secured puts because I found those are the most profitable, because the stock market tends to move up. And because of that, you can sell puts, especially when you find the right stock or ETF. I've actually done a video about cash secured puts. You can go find it on my channel, and that will help you out a lot. Now, here are other option selling strategies, and I no longer use these. These are put credit spreads, call credit spreads, and iron condors. A put credit spread is basically sell a put, but what you do is you buy a more out of the money put as protection. With call credit spread, you sell calls, but you then buy a more out of the money call as protection. In iron condor, you have a put credit spread and a call credit spread open on the same stock or ETF at the same time. I no longer use these because they're not as profitable as cash secured puts and covered calls. They look like they could be more profitable, but they're not. It's because the market tends to drift upward. The market moves up 9 to 10% on average per year, and because of that, your call credit spreads and the call side of your iron condors will be threatened, and then you have to roll those over or close those for a loss. So I personally recommend cash secured puts or covered calls. They generate a little bit of an income, especially if you're doing weekly options, you sell weekly cash equivalent puts or weekly covered calls. You generate a little bit of an income, but because of the high success rate of these trades, that little bit of weekly profit really adds up over time, and you'll be surprised how fast your portfolio will grow over, after a couple of years of doing these types of trades. So I hope you enjoyed this video. If you did, please be sure to leave a like and go ahead and subscribe and turn on notifications, because I do educational videos like this on the weekends, and then every day the market is open, I do breaking news on stocks and the stock market. Okay, thank you very much. Bye.